Hello everyone, it's Feng here. Today we'll be talking about capitalism and the manufacturing process. Again, the information here is sourced from the book The Truth About Money by Rick Edelman. So getting started with capitalism, well, in capitalism, the government and businesses need capital, also known as money, to achieve goals. And these goals are either social, political, financial, etc., right? And to raise capital, they do it by selling certificates with value. And I have value in quotation marks is because the certificates have, supposed, value, but it's up to our belief in these government and businesses to actually prove that there's value in these certificates. So the public needs to believe in these certificates or else the economy is going to collapse, right? And these certificates have value because they either generate income or grow in value. Now let's talk about how we use products, right? So in capitalism, we are consumers, and as consumers, we use products. So we use products either by consuming them, donating them, throwing them away, or selling them. Now let's talk about the manufacturing process, and this starts at the manufacturer, then the distributor, then the retailer, then the consumer, and then product use of like what we just said previously, the four things. And this process is everywhere, okay? Whether it be real estate developers, car companies, corporations. So for example, corporations are the manufacturer here. They raise money to have their businesses, right? By selling these certificates to brokers and dealers. Then the brokers and dealers are going to sell them to the investors who are interested. This process is called the initial public offering, also known as the primary markets. And then the investors are going to sell it to other investors so that they can make money, right? So this is called the stock exchange, or also known as the secondary market. So again, right here, the manufacturer is the corporation, then the distributor is the brokers and dealers, retailer are the initial investors, then the consumers are the secondary investors, right? Now there are two types of certificates, bonds and stocks. And we'll get into the differences between the two. So starting off with bonds, they're also known as income or debt. And bonds pay you interest and eventually return your money, right? Your principal. But however, with bonds, you have no control or ownership of the company. So in this case, bondholders are lenders essentially, right? Because in bonds, you lend money and make money as long as the company is in business, because the company will pay you interest and they will pay your money back at a predefined date, also known as the maturity date. But if the company goes bankrupt, you actually rank really high up in the list of creditors in bankruptcy, and you're next to the IRS and employees, essentially. As for stocks, they're also known as growth or equity, and you do not get paid any interest, nor your money is guaranteed to return, right? In fact, you actually gain control and ownership of the company, so that's the benefit of stocks. In this case, stockholders are owners, so you have no idea how much you will earn or lose, and there's no predefined date that you're going to get your money back. And if the company goes bankrupt, you rank really low on that list of creditors in the bankruptcy court. So let's talk about investments and the risk versus the reward here. So all investments are either equity, ownership, like stocks, or debt, ownership, like bonds. And the quote, greater risk is greater reward is so untrue. Okay, that is not true. Greater risk does not equal greater reward. In fact, it's because you are certain to have greater risk, right? But you're uncertain to have greater reward. In reality, it's more greater risk equals potentially greater reward, right? There's a potential, but it's not guaranteed. Your greater risk is guaranteed, but the greater reward not. So typically investments with a higher return are likely to have a higher degree of risk. Now recapping everything that we learned, first is that capitalism relies on people believing in the certificates and these values of them. Second is the manufacturing process, right? It starts at the manufacturer all the way down to the consumer and how they use that product. Remember that bonds are essentially loaning, stocks are owning, and remember, refer to the old slides to know the differences, right, between the two. And that all investments are either equity or debt, okay, all. Even the very specific ones will fall under one of these two, essentially. And remember that greater risk equals potentially greater reward, right? Doesn't equal greater reward, potentially. So that's it for the video. Thank you guys for watching, and yeah, see ya.